Hello and welcome. This is Steve Covell. I'm a registered investment advisor, attorney, author, and I invented the prosperity wheel as a means to explain to people why the outmoded way of investing that has been used by brokers for the last 100 years no longer works. This is part of a series on how to use the prosperity wheel for specific problems. So let's jump right in. We're going to talk about Nancy, who is a successful businesswoman who owns her own business. Now, she's been paying for years for long-term care insurance because Nancy understands that the biggest vulnerability for her portfolio is that very expensive probability that during her lifetime she will need long-term care. That is, she may need a nursing home or she may need someone to look after her in her home, but she does not want to be a burden on her children, so therefore she's paying $1,800 a year for long-term care insurance. She was fine with that. She can afford to pay $1,800 a year, but the problem is this. Until recently she was paying $1,400 a year, but they just recently raised her premiums. Nancy understands that the insurance company, and this is typical of all long-term care policies, the insurance company has the right to raise her premiums whenever they want. Now, they can't just raise her premium, they have to raise everyone in her age group. But what do you suppose that means as she reaches 70 and 75 and 80? Of course, it means her premiums will likely go up. So this is what we did. Nancy has a pretty good portfolio and she has a large amount in managed cash funds, money market, that sort of thing. We took a portion of her cash position and put it into $100,000 for a premium for a special type of policy. So we didn't actually take the money out of her portfolio. It is still there, and this is the reason. The policy we chose is a very special policy that has something called a return of premium guarantee. That means that anytime Nancy wants, she can tell the insurance company, okay, send my premium back. And they will send her a check for $100,000. Now, it doesn't really matter whether it's the day after or years down the road. Anytime she wants her premium back, she can have it, no questions asked. Now, obviously, she didn't get this policy just to have $100,000 move from one place to another. Now, one feature of this policy is immediately after she gets it, if she dies, her beneficiaries will have an immediate tax-free $166,339 death benefit. But obviously that was not the reason we chose this policy either. The real reason is this. From day one, Nancy will have $499,000 available to her should she need long-term care. Now that includes long-term care whether it's in an institution like a nursing home or whether it's in her home. The effect is Nancy will have $6,931 that will be payable to her every month for as long as 6 years, and she can use that for her long-term care expenses however she wants. Also, under the new laws that were passed in 2011, that money will be tax-free income to her as long as it is used for long-term care. So, how did the prosperity wheel help Nancy? If you have gone through the instructional material at our site, prosperitywheel.com, you will know that the broker wheel is a model that's been used for 100 years by the broker industry, and it is simply a mixture of risky, highly taxed investments like stocks, bonds, and mutual funds. When the market really takes a dive, all of these things will take a dive. On the other hand, the prosperity wheel is built around the idea that you want no risk, and you want to have your taxes either reduced, deferred, or tax-free. So what did we do in Nancy's case? We simply took $100,000 away from the broker, away from where it was taxed, away from where creditors could seize it, and put it into the core money portion of her prosperity wheel. What did that do for her specifically? Well, first of all, $100,000 is now safe. In most states, money in an insurance policy like this cannot be touched by creditors, not even in a bankruptcy. Secondly, this is tax-free money if it is paid out to her beneficiaries, or if she needs it for long-term care, not one penny will be taxed. In addition, Nancy was able to add $1,800 per year to her cash flow. That was money she was paying in premiums that maybe, with some luck, she would never have to use for long-term care. But the other side of that coin is it was $1,800 a year wasted if she never needed it. Now it is in core money where it's there if she needs it, but if it isn't, she can get it back if she wants to, or it can go to her beneficiaries if she dies. Well, that's about it. In just a few minutes, I explained just one way the prosperity wheel is really helpful in specific situations. This is Steve Covell. I urge you, if you haven't so far, go to theprosperitywheel.com and check it out. Thanks for listening, and I'll see you again.